Hey there, Kenneth French of Vast Voice, telling business secrets to entrepreneurs. We're very, very happy you stopped by. Either you're going to watch this or listen to this because you want to take your business to the next level. You're probably an entrepreneur who's either just starting out or you've been around for quite a while and you want to take your business to the next level. You're probably a real estate investor, maybe even a real estate agent, maybe a professional or of some sort, professional advisor of some sort. And well, you are stopping by because you need some valuable advice from one of the top industry leaders there is. Anyway, thank you very much. Once again, Kenneth French, Vast Voice, telling business secrets to entrepreneurs. Really glad you stopped by.
Tax-free. Tax-free. Two words that you should love when they're combined to equal tax-free. Hey there, Kenneth French with vastsolutionsgroup.com. Again, vastsolutionsgroup.com. We're here to talk about tax-free investing, and even we're going to have some elements that are going to surprise you because we're going to be talking about ways to make you money on a tax-free basis, sometimes using insurance, sometimes some elements that are, you're going to be very surprised as a result of this. We're not going to take too long. We're going to go through it very briefly, but it's going to be briefly enough that I think you're going to learn enough that you're going to say, "Whoa, I didn't even know that all that stuff was possible." By the way, we've been doing this since 1969. I've been with the company since 2006. We know what we're talking about. I'm a three-time author. I'm going to my computer. I'm a three-time author. Used to write for Forbes.com. I'm a keynote speaker. Let's get right to it. Let's talk about tax advantage investing, tax-free investing, retirement income that you cannot outlive. So a lot of people don't realize. I mean, how much money it takes to live on. I'll just give an example. Let's say you're retiring at age 65. You're probably going to be around for 20, 30 years. That's something to think about. And if you're not going to work, what's going to happen? You've got to have two things. One, you got to have money that's going, a rate of return that's going up so you can live for a long time and not run out of money. And then also not take too much of money out of the portfolio so you run out of money. So, because those are, if you really think about it, those are the main things. You have expenses. I mean, you have a whole bunch of things to worry about. And by the way, the biggest consideration, if you really think about it, would be taxes. Because you don't want to change your lifestyle, but what's one thing you can do? You can change the tax element of your retirement income. That's going to be your biggest expense, generally speaking, right? By the way, every circumstance is different. You just never know what's going to be right in your circumstance. I would say go talk to your professional advisor. Come in, check in with us at vastsolutionsgroup.com. Go to our website. But if you go to an advisor who knows your situation, they're probably going to be able to help you better than anyone. But, if you need a sounding board, a second opinion, maybe we can help you. So, I mentioned insurance. I used to hate insurance. I used to think insurance just totally didn't make sense in so many cases because the insurance premium really is eaten up by the commission going to the real estate agent. But sometimes it does make sense because of the tax-free element. It really, really does. Every situation is totally unique. So, here, I put this presentation together. They enjoy high yield sometimes, and sometimes, meaning relative to the stock market. Sometimes it's a good proxy for the stock market. Sometimes it's a good diversification away from the stock market. When I say it, I mean in insurance. So, let's take a look at the various types because there's so many different types of life insurance. There's permanent life policy. Let's go over it. So there's whole life. Here a portion of the premium, which is the check that you write to the insurance company, it rests. A portion of it goes to the insurance company, i.e., also the agent who represents the insurance company in some cases, and the rest goes to cash value, which grows and grows and grows. Each month, the company pays money to have that grow. It could be a small amount, middle amount. The insurance company is the one that announces what the whole life policy's cash value would be. Here, Universal Life, its interest rate is paid to the investor, in this case, the policyholder, based on changing market rates. It's a little bit riskier than a whole life, and sometimes it's tied to an index. IUL is sometimes what they're called, index universal life, depends on the circumstances. And then variable life. This is the most risky type. So let's just say a whole life is intended for someone who's a little bit older, a little bit more mature, who doesn't want any money to go down, the investments go down. Universal life, someone who's a little bit riskier, and a variable life policy is someone who can be very risky because the market portfolio, the portfolio is tied to usually an index which is tied to the stock market. So it goes up and down a lot. And I mean, significantly. It buys stocks, bonds, et cetera, et cetera. So it's not as, universal life is kind of in the middle. Whole life is conservative, variable life, very conservative. Universal life is a little bit more conservative because it's based on, you have minimums and maximums the insurance company provides. Variable life, generally speaking, it doesn't. It can go up a lot and it could go down a lot. Hence the reason I say that, it's made for someone who can be a little bit more aggressive in their investments. So what are the guarantees? Let's talk about that. They guarantee the death benefit, generally speaking, by the way. It's funny. I wrote it upside down. There's a reason, actually. Since both the death benefit and the cash value are guaranteed, you'll know the quote from the quote how much money you're going to have down the road. The insurance company can tell you if you put in X dollars today, you'll have whatever, $300,000 down the road. Okay. And here, the rate of return is also guaranteed, so you'll know what you're going to get when you're retired. When you retire or take the money out. Or no, when you retire. So, and it guarantees the death benefit. There's another one that's upside down. You'll see why way later in the chat. The insurance company for universal life, by the way, I'm just giving an example for now. Universal life, the insurance company estimates a range of dollars you could have by a certain range. Going into it. So the actual amount, though, could be more or less than the company's estimate. So it's a rough estimate, and the interest rate it changes over time, right? And the variable annuity, the company make an estimate based on market trends, but it all depends on the money you invest and how the stock market goes. Again, hence the reason it's a little bit more risky. Tax strategy: how to get tax-free gains. Avoid canceling your policy. Don't cancel your policy because therefore it's not tax-free. The money in your life insurance account grows tax-deferred as long as you leave it in the account and you don't owe taxes on it. The cool thing is you don't owe taxes on it. Now, if here you see, if you decide to cancel your life insurance policy and cash out your investments, you owe taxes on those gains. So you should, generally speaking, avoid cashing out your policy. Now, if you follow this process, the one I'm just about to mention, you can get a policy loan. Luckily, the government does not tax loans. They won't. It'd be tough for them to tax loans. So the death benefit could pay off your loan down the road. That's kind of the magic of these policies. I'm learning more and more that's the case. The government does not tax life insurance death proceeds at all. So now, if you use a life insurance policy as a tax-free investment, now let's talk about the downside, right? You have to be healthy enough to qualify for the insurance. If you're, I've had some people really, 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 really ill and, they're coming close to death and they can't get life insurance even though they probably want it. What's the best time to get life insurance? When you don't need it, right? It might be an option if you have serious health issues in some cases, but generally speaking, no, because you have to do a medical exam. And by the way, some people use that as an advantage. Instead of going to an exam for the doctor, you could apply for life insurance and you get your life insurance exam quicker. Makes sense in some cases. Your investment, again, the downside, your investment gains will be lower than if you had just invested in the stock market because of fees, money goes to the death benefit, money goes to the insurance company and the agent, etc. Now, how can life insurance investing be beneficial? Because everyone's been talking about infinity investing, invest in yourself. That's to a certain extent kind of what this is about. Some people are now more than ever talking about that as a means for increasing the net worth. How can life insurance investing be beneficial? It's really advantageous if you cannot qualify for a regular retirement plan. So let's say you've tapped out your 401k, you've tapped out your defined benefit plan or your IRA, whatever the case is. So, and by the way, if you're making too much, you're not allowed to use your IRA. So why not then use life insurance? And we have a lot of people who are, who are listening and watching, as a matter of fact, who, they've tapped out their defined benefit, which you can usually put in the most in defined benefit plan. And so they think, well, wow, what do I do now? They look at a life insurance policy. Now, now think about that. So you've tapped out your tax deductible defined benefit plan. You've tapped out or put as much as you can in the 401k. What then? You're looking around. You don't know what else. One option, at least to think about, is the life insurance policy. Because the nice thing about that is there's no maximums, just like there is for a profit sharing plan, defined benefit plan, 401k plan. Okay, and there's no income restrictions. Now, let's keep talking about some of the benefits. if you want life insurance to protect your family for your family's benefit, that's a huge benefit. And there's some estate planning issues that can be beneficial because you're using life insurance. Now, plus, yeah, I forgot that I put this down. If you struggle to make ongoing contributions to a retirement plan or investment plan, well, permanent life, it offers automatic investment. It makes you pull the money out to the policy. Annuity investing. I worked for ING for years, and we help people with annuities, variable annuities, fixed annuities, variable fixed annuities, etc. So let's talk about the various different ways of annuity investing. There's, generally speaking, two types of phases. There's an accumulation phase where you put the money in and it grows and grows and grows. And then there's a payout phase or income phase when you're in retirement or you need money, it pays out to you, the investor. So what are the risks of both? On the fixed side, you know your rate of return, usually for a little bit more conservative people. You know exactly what you're going to receive. On the fixed side, low risk, right? Variable annuities, bigger rate of return, generally speaking. You don't know what the portfolio is going to be worth down the road. And there's mainly because there's no guarantees. Now, what's the top benefit of an annuity that life insurance does not offer? So we're now just talking about annuities. An annuity offers a guaranteed rate of return for the rest of your life. There's some benefits on top of annuities now. Offer rates of return. By the way, they offer rates of return that go for the rest of your life. Plus, you can have rates sometimes as high as 7%. You put in whatever, $100,000 on an annual basis, you're going to get a 7% rate of return, sometimes on the premium, sometimes on the growth. So meaning there's guarantees that are based on growth, and also when you start triggering the income, you get a rate of return. Okay. Now you can get in illustrations. Go talk to your advisor. Go talk to your insurance provider about annuity payoffs and payouts, so you know what kind of income you're talking about down the road. Then the question is life insurance or annuity, which one's right? It really depends on the circumstances. But if you have children or need a life insurance policy, you want to take care of your beneficiaries, sometimes life insurance. If you want to retire early, you can take out loans without restriction, invest in real estate, bank on yourself. You don't have to go to a bank for assets, right? Take money out of your policy. You don't have to repay the loan because the loan is affected at death. If you do die, well, the death benefit will be paid to the heirs will be reduced by whatever money you've taken out. So your heirs are taken care of, tax free, which is pretty nice. An annuity, if your goal is to reach retirement with the most money, probably that, in my opinion, that makes sense. By the way, this is not investment advice. I'm just giving, let's call it for entertainment. Especially if you don't qualify for life insurance, you should get an annuity in some cases. And if you're single, you have no kids, you don't need life insurance, maybe annuity will make sense for you. Now let's talk about tax-free and tax-deferred income strategies. Strategy number one, use life insurance cash value for tax-free income for investing on, infinity investing, cash value investing. If you only use life insurance to fund your retirement, all your income would be tax-free, which is cool. Remember how I was talking about tax-free? Well, that's nice. You've put in all your money into a life insurance policy. Income is tax-free that comes out of it. Okay. And again, that's a good proxy. If you've maximized your 401k, you've maximized your defined benefit plan, you have no other kind of ways to, tax strategies, tax-free investment of life insurance might make sense. And, as long as you keep your insurance policy in force, that's important. You can borrow money from it tax-free. Invest, like here, we have a lawyer putting money in his defined benefit plan, $200,000 a year. He saves roughly $80,000. He's in California. Pulls that $80,000 a year out, and what does he do? He puts it into life insurance. What he's doing is he's putting it into life insurance, one for his heirs, although that's becoming less and less of an issue. But the nice thing is he, down the road, he hasn't yet, but down the road, he's going to start pulling money out, and he's going to leverage that into commercial real estate. So let's just say, let's say in 5 years, it's worth $600,000, whatever. And he does a 2-to-1 leverage. So it's $1.2 million. He can buy a $1.2 million building, let's just say, right? And the cool thing, actually be a little bit less than that. Let's just say it's $1 million. And then let's say he's getting 7% yield off that. That's 70 grand that goes basically back to him personally, right? Think about that. Now, you got to like that. Basically, it's all predicated on the government giving him a deduction of $80,000 on his defined benefit plan. Anyway, I digress. Then you die. The death benefit from the policy will pay off the loans. Nobody else has to pay them. The heirs don't have to worry about that. And if I lost you in that concept, the bottom line is defined benefit plan, tax result, invest the tax result into life insurance. You don't have to go to a bank when you pull money out, tax free. Invest it, leverage it. You have death benefit and leverage it to buy commercial property that's bringing in a yield. That money goes back to you, in this case to him, to the lawyer, and he's living a pretty high and fat life. Strategy number 2, use annuity to guarantee income. You can ask the company to turn on annuity payments. You take an income for the rest of your life. Very nice. 1035 exchange. This at one point was very, very popular. It's going to become more popular here down the road as interest rates change a little bit. Life insurance. So now with the 1035, basically you can turn life insurance into annuity. The transaction is not a withdrawal, so you move it from one policy to another policy, and you get tax free. It's a tax neutral event, and then you take income stream down the road because you've moved it from life insurance into annuity, and you're taking income stream. Usually, it will be higher annuity than it would have been in the cash value. And that's one thing to think about, especially if you're in a life insurance policy that's one of those infinity investing, and it doesn't make sense. It doesn't give you enough income. The annuity might get you much more income. And then here, one strategy: use annuity plus life insurance. If you're married, base the annuity on one partner. Let's say the spouse. Let's say it's a husband, right? And have the life insurance on the same partner. If he dies first, the wife gets tax-free income going forward. Now, if he dies last, continues to receive payments, especially if he then 1035s it and gets a higher income. If you're younger, sometimes it makes sense. Life insurance policy. Really, at that case, if you're doing the infinity investing, investing in real estate for older, it's nice because you have the death benefit. Now, let's compare all the tax strategies, all the tax advantages of the strategies. Number one, it's the only strategy that is completely tax-free, therefore the life insurance. Again, tax-free, right? Number 2, 3, and 4, delay taxes until retirement, which gives you more time to grow. The longer you don't have to pay taxes, the higher the rate of return because you're not being taxed on the money on an annual basis. So let's say you put in 100,000, conceptually put in 100,000, and then let's say there's a rate of 7%, and then the next year 7%, the next year 7%. Well, if you don't have to pay taxes on that, but you pay it when you pull the money out, you can strategize how you take the money and how you're impacted by taxes down the road. There's a lot of strategies when you're taking income out. So 2, 3, and 4, you delay taxes until retirement, which is nice, very nice. And then 4, life insurance annuity, you'll pay less tax because life insurance death benefits are tax-free. Now, how do you get started? You got to reach out to your advisor. I would say reach out to your CPA first, go over the math, have the CPA go over the math, and then talk to the life insurance agent. I know that's backwards, but I believe in how do you know what let's say option A is better than option B unless you look at the finances. Usually I think CPAs are pretty good at looking at the mathematical elements of the two options and see which one's better for you, the investor. Life insurance, sometimes they might not be as acquainted with knowing the best scenario mathematically. Look at the end result, and that's mathematics, and then get deep and do deep dives with life insurance policies. Or sometimes I say, okay, bring everyone to the table. Bring your attorney to the table, bring your CPA to the attorney, your financial advisor to the table, and finally, then, as I mentioned, your CPA. If they're all on the same wavelength, if they're all sitting around the desk at the same time, you'll find out which one's probably the best scenario because every single person around that table will be able to provide good feedback for you. Now, what I would also say is, let's talk about consultation. So it's important. Why do I say it's important to kind of talk to everyone, get everyone's opinion around the table? Because finances are impacted by so many things. Finances are impacted by tax. Finances are impacted by financial advisor, by lawyers, by insurance. So if everyone's communicating and optimizing your situation, you should be much better off in the long run. Now, I would also say go back to your advisors. Sure, this presentation, people who are watching and listening, we love new business, but the people who you're working with probably know your situation better than anyone. If we can be of help, if we can also have a seat around the table, we're down with that. We're really willing to help in any regard, right? We believe in making sure you're taken care of on a tax efficient basis. I don't care if it's tax free or tax efficient, whatever the case is. We lead with taxes. Our moniker, tax, finance, and artificial intelligence to help the entrepreneur. And now we've added estate planning and asset protection. Whatever we can do to lower the taxes, those are always going to be your biggest expenses, generally speaking, are taxes. So if we can help lower the taxes, if your advisor, one of your advisors around the table is helping you to lower your taxes, your rate of return will be better, right? Why wouldn't you want to bring around the table someone who does taxes? So anyway, also because you've stuck with this long, free book, info@vastsolutionsgroup.com. You're going to get this bonus, a free bonus. If you email info@vastsolutionsgroup.com, it's a number of articles that I've written over the years. I've been writing, I'm a Forbes.com small business contributor. I've been doing this for longer than I'd like to admit. It's called Entrepreneur's Manifesto, a collection of smart financial advice. It's, one lady said it saved her $100,000, one idea in this book, which still blows me away. That's unbelievable. And by the way, I gave her the book. She didn't have to pay for it, but I digress. But what I would say again, in closing, what I want to do is, open it up, begin a dialogue with your professional advisors. If they don't understand some of these concepts, we've been doing this since 1969. We're here to help. I've been doing this since 2006. We have attorneys, we have CPAs, we have financial advisors who are here, who are willing to help you if you need any help, if some of the people don't know some of these concepts, et cetera, et cetera. Check us out on the web, info at vastsolutionsgroup.com, or email us for any suggestions, et cetera, info@vastsolutionsgroup.com, and for your free book, for your bonus. Hey, thank you for taking the time. Kenneth French from vastsolutionsgroup.com.